Hi guys, how are you? Welcome back. Let's do another video. We're going to talk a little bit more about the magical, um, legal $1 trillion coin. Okay. Now, we talked about in the last video how the um, executive branch basically bypasses the bypasses Congress, bypasses the courts, and it becomes very dangerous because they can just issue these $1 trillion coins and spend whatever they want. And the problem with that is not only does it bypass the three branches of government, but it also starts to eliminate the bond market, right? Because what happens is the Fed has to buy bonds in the open market, exchange them for cash, and those bonds are then wiped out with a $1 trillion coin. Okay. Now, the problem with that is that the bond market it sets interest rates, right? The free market sets interest rates. Now, the short-term rates are controlled by the Fed. However, the longer-term rates are controlled by the free market. Now, why is that important? You see, economics is beautiful if you understand it. When the bond market starts to sense uh, there is a recession, what happens is money flows into bonds. Bond prices rise, interest rates fall. Okay, so let's talk a little bit about that. So a lot of people get confused. Think of bonds like this: when the bond prices go down, interest rates rise. Okay, when um, uh, the opposite occurs, okay, when bond prices rise, interest rates go down. Okay, so this is interest rates, right? These are the bonds. So think about it as a recession. Money flows into bonds. Bond prices go up. Okay, interest rates go down. All right. Now, why is that important? Because you want to make money cheaper. Okay. At the same time, the bond market is going up because of fear. Okay, they're safe. Er, er. Bonds are safer. So money comes out of stocks, generally speaking, not always. Money comes out of stocks, commodities, real estate goes into the bond market. Bond prices go up, interest rates come down. Now, you'll hear a lot of people on the net saying, oh my God, look at all these interest rates that we're paying to these bondholders. Oh, it's just free money, it's income, blah, blah. It supports the economy. Oh, nonsense, utter nonsense. Because what happens is for interest rates to rise, okay, bond prices must go down. So bondholders lost their ass um, in order for interest rates to go up. And if you want to participate in those interest rate hikes, that means you must have had cash on the side that you're now going out and buying those bonds to give you that interest rate. Okay. Now remember, interest rates were zero, so people were buying bonds at you know top price. And then what happened is, and that includes pension funds. And what happens is when the bond prices start to fall, interest rates rise. Well, guess what? You just lost a bunch of money. Okay. Now you can make an argument. It's like, well, if you hold up to maturity, you get your money back, and that's true. However, you have an inflation problem. So if you're getting 0% interest rate and the price of a bond comes down and you're losing money to inflation, how is that beneficial? It's not. Okay. So you get a lot of this nonsense on X, how bond holders are becoming so rich and it's free money, and but nobody's telling you the other side that trillions and trillions of dollars were lost in the bond prices collapse, right? They're not going to tell you they lost trillions more on inflation because that money now is worth less. Okay, you need more of those dollars uh, to buy the same things. So, of course, X is not economically savvy. So people run around like, oh, the bond market and, those bond holders are savers, free money. Don't listen to it. All right. So getting back to what I was trying to say before, that if you do use this gimmick with the $1 trillion coin, you're going to end up um, removing bonds. Thereby, you're removing the ability for the free market, for the economy to self-correct itself. Okay, because when there is a recession, bond prices are not going to rise. I'm sorry, they're not going to rise to bring down interest rates. I'm getting confused. To bring down interest rates to make money cheaper, right? And the same thing in reverse. If the bond market is gone, guess what? You're not going to sell off bonds to raise interest rates during an inflationary period, okay? To make money more expensive to contain inflation. Most recently, we had the bond market raise interest rates before the Fed caught up. If you remember, the Fed kept saying, oh, it's transitory. Don't worry about it. It's good. No, no, it's transitory. It's transitory. Meanwhile, the bond market is like, no, it's not, right? And started to raise interest rates. Eventually, the Fed caught up. So, again, if you remove this bond market and the free market's ability to try to self-correct the economy with this little gimmick of a $1 trillion coin, you're really causing yourself a lot of harm. Not to mention that you're going to give the executive branch all this power to willy-nilly start printing money, okay, and spending it and spending it. Eventually, people are going to lose faith in the currency, which we're going to talk more about later on. Why interest rates work to bring down inflation in some periods, and then other periods, even if you take it to 100% interest rate, you're not doing anything. Right? That's probably going to be the next video. Thank you for watching. I'll talk to you guys soon. I hope this is making sense. If it's not, put put a comment on the below. I will explain it to you better. And don't forget to like and subscribe. Come down to patreon.com/realmacro and subscribe and follow along. And don't forget to watch the previous videos on how money is created. Okay, we're going to talk a lot more about money creation and the macroeconomics, um, uh, trading, investing, trade setups, charting, all that good stuff. All right, guys, take care of yourself. I'll talk to you soon. Thank you. Mwah.